Inflation is on the rise. Let's take a look at what's going on using our economic pressure tracker and what it might tell us about where the economy is heading. Here's our chart for consumer price inflation. We put the green line in here. That's when the US-Israeli attacks on Iran began, the start of the war, and we can see how that's impacted the economics. 2.9% was the path of inflation, up 0.3% on June. That's driven largely, almost directly, by a change in the energy price cap, which sets the domestic price of energy for most of us. Now, it was falling into the second quarter. This chart is broken because Ofgem's actually changed the way it calculates what an average household spends, but it went up 13% in the cap for the period July to September. And actually, the red line, the forecast, is that it will continue to rise as the year goes on. So that is a cause for concern. Now, a couple of factors that are actually dragging back the inflationary impact of energy prices. One of them, it might not feel like it, is fuel prices. But these are July's numbers, remember. And look, as we went into July, petrol prices were falling because the oil price was stabilising. Another factor that will be welcome, and again, you might not feel like it, but food inflation is declining. So prices aren't rising as fast as they were. So that is another positive. Now, we can take a look at the commodity prices that underlie those household bills. Oil, we know, has jumped around and gone up sharply since the war began. But I want to look at natural gas briefly here. It is on the march upwards. Gas sets the price of electricity effective in the UK. It's hugely important in our energy bills. And if that does march up, it hasn't risen as fast as oil since the war began, but if it does, that is going to be a challenge for the economy. Let's talk about the economics of this. The Bank of England watches these inflation numbers closely when it considers its base rate, the path of interest rates. 3.75% right now. Expectations they'll be held there in September, but the market thinks there'll be another rate hike this year. It's not certain, but perhaps we'll be up at 4%. One other number to draw attention to, gilt yields. This is effectively what it costs the British government to borrow. This is trading near to 20-year highs. That's not just a UK problem. It's been reflected across Europe and the United States. So there's concern about the level of debt, about political instability, about the path of interest rates. There's also an AI factor here. AI companies raising their own debt, which might be preferable to government borrowing or lending to governments, but also a sell-off potentially by AI and tech companies to raise the cash to invest in AI infrastructure. So all of that food for thought for the Chancellor. That kind of interest rate is costing the government £100 billion a year. So much to consider as we follow inflation into the year using our economic pressure tracker. It's a really useful tool for digging below the headline figures.